In the West, we've always been told the same story. Strong nations have strong currencies, and weak nations have worthless money. But what if that story is wrong? What if weakness was never weakness at all, but strategy? China proved it. For decades, it deliberately kept the yuan undervalued, not because its economy was collapsing, but to gain leverage over the world. And that single decision reshaped the global economy. The story begins in the late 1970s, right after Mao's Cultural Revolution. China was exhausted, poor, and isolated. Its factories were outdated, its production almost non-existent. Then came Deng Xiaoping. With the reforms he launched in 1978, China opened to global trade. Factories rose in coastal cities, foreign investors poured in, and Beijing's mission became clear: industrialize fast. But how could a struggling economy sell to the world? By making its goods cheap. And the fastest way to do that was through the currency. Here's the simple logic behind all the financial jargon. Imagine $1 equals 5 yuan. If exports soar, the yuan should rise, maybe to 4 per dollar, making Chinese goods pricier abroad. Beijing didn't want that, so its central bank bought dollars and sold yuan, forcing the exchange rate weaker, sometimes near 8 per dollar. That kept Chinese exports irresistibly cheap. The result was historic. American homes filled with made-in-China goods. From televisions to toys, shirts to smartphones, everything came from China. It was like Nike selling $50 sneakers for $10. Less profit now, market domination later. That's exactly what China did. It devalued its own currency to win the future. Throughout the 1980s, 1990s, and early 2000s, China's factories multiplied and trade surpluses broke records. Western consumers loved the low prices. Walmart became globalization's temple. But while Americans cheered cheap abundance, the real winner was China. A weak yuan made exports unstoppable, and the dollars it earned went straight into U.S. Treasury bonds, financing America's own debt. The West saw weakness. China saw power. By keeping the yuan low, it bought time to build industries, infrastructure, and lift millions from poverty. While others celebrated short-term gains, China was playing for centuries, and by the early 2000s, the transformation was complete. A once isolated, agrarian nation had become the factory of the world. To the West, China's rise looked like a miracle of globalization, but for Beijing, it was proof that the plan had worked. Keep the yuan weak, grow exports, and pile up dollars. Yet every strategy creates enemies. In Washington, politicians began accusing China of currency manipulation. They weren't wrong. China was intervening, but it wasn't corruption. It was geopolitics, cold and deliberate. A cheap yuan filled American stores with low-priced goods, but it also emptied American factories. Production lines shifted to Asia, and small towns across the Midwest fell silent. In the short term, consumers celebrated bargains. In the long term, the West's industrial backbone rotted away. Meanwhile, China's manufacturing machine grew unstoppable, and the irony deepened. Every dollar spent on Chinese goods became a dollar China used to buy U.S. debt. The profits didn't gather dust in vaults. They funded Washington through Treasury bonds. Soon China had become one of America's biggest creditors. A strange codependence formed. The U.S. condemned China as a manipulator, yet relied on that same manipulator to finance its deficits. China sold cheap goods, then lent the money back so Americans could buy more. Consumption and debt became a loop, tightening China's quiet control over the global system. The West's illusion clashed with reality. In America, a strong dollar was a symbol of pride. For China, a weak yuan was leverage. Beijing gave up the prestige of a strong currency, but gained the substance of industrial and political power. The West mocked China's cheap labor and undervalued currency, not realizing those tools were the very foundation of its rise. While Western leaders praised consumer freedom, Beijing was executing a centuries-long plan. Of course, the strategy had costs. Keeping the yuan weak demanded endless interventions, sometimes fueling inflation at home and painting a target on Beijing's back. Trade wars erupted, tariffs followed, but by then it was too late. China had already conquered global supply chains. From textiles to electronics, steel to toys, a world without China was no longer possible. So the strategy evolved. By 2005, Beijing allowed the yuan to rise slightly, just enough to silence critics. By the 2010s, control loosened further. The goal was already achieved. China no longer needed a cheap currency to dominate exports. It already owned the factories, ports, and workers. The weak yuan had been a ladder, and once China reached the top, it kicked it away. When the IMF added the yuan to its reserve currency basket in 2016, it marked more than a symbolic moment. It declared that China was no longer just a producer of cheap goods, it had become a power on the global financial stage. Yet the mindset behind its old currency strategy lives on. China is still playing the same game, just on new fields: steel, solar panels, electric vehicles. It floods markets, not to profit, but to dominate. State-backed firms accept losses today to destroy competitors tomorrow. The logic remains the same: short-term sacrifice, long-term control. But this is no longer only about exports. China now seeks monetary sovereignty, the power to challenge the US dollar itself. Oil deals in the Middle East, yuan-based loans under the Belt and Road Initiative, and the Digital Yuan Project all serve one goal: to build a world where the yuan, not the dollar, commands trust. If that vision succeeds, Beijing won't play by Washington's rules anymore. It will start writing its own. Here lies the great irony. In the West, a weak currency is treated as a shame. Politicians boast of a strong dollar or strong euro, but China proved the opposite. A weak currency can be a weapon. By keeping the yuan undervalued, it built factories, bought time, and lifted hundreds of millions out of poverty. It traded prestige for power, paper strength for real strength. Meanwhile, Americans lived under the illusion of cheap abundance. Their industries withered, their debt ballooned, financed in part by China, and the lesson is clear. Don't trust the number flashing on the exchange rate board. A weak currency isn't always weakness. Sometimes it's strategy, and strategy wins. History doesn't repeat, but it rhymes. Rome debased its coins to stretch its empire. Spain flooded Europe with silver to fund its empire. The United States prints dollars to sustain its empire. And China? It devalued the yuan to build its empire. The tools change, the game endures. Money is never neutral, it's always a weapon. If this story changed the way you see money and history, hit subscribe, because history already holds the answers. I'm just here to help you find them.